You are one wrong zip code away from losing your entire down payment on a ghost town property. Investors dump millions into markets based on social media trends, but when the bubble bursts, they are left with empty houses and negative equity. Analyzing raw data before you sign a deed is the only thing separating a real estate fortune from a complete financial disaster. Here is how you evaluate any market. Today, I have saved the most reliable data driven indicator for the very end, and it is the single metric that separates professional investors from the amateurs. So sit back, grab a cup of water, and let us get to work. The first step to analyzing a market is understanding the job market's health. If you are looking at a town, you need to know who the largest employers are and if they are planning to stay. A few years ago, I had a student named Marcus who was eyeing a quiet suburb in the Midwest because the home prices looked like a steal. He saw low taxes and cheap entry points. He did not check the major employers until after he closed on the house. It turned out that the town's only significant factory, which provided nearly 40% of local jobs, had announced a permanent closure just 3 weeks before his purchase. Property values plummeted within 6 months because the population started leaving the town in search of work. Never guess. Always verify the economic foundation. Look for markets with job diversification. Ideally, you want to see a mix of industries like technology, healthcare, or government, rather than a single company town. You can use a tool like the Bureau of Labor Statistics website to pull up the unemployment rate for any county in the United States. If that rate is consistently climbing, keep your wallet closed. That is the easy win, but now we need to look at the supply and demand dynamic. This is the second point, and it requires a bit more digging. You need to check the inventory levels in your target market. If there is a massive oversupply of houses, your property will sit on the market for months if you ever decide to sell or rent it out. A simple way to measure this is the months of supply metric. This tells you how long it would take to sell all available homes if no new listings hit the market. A balanced market usually has about 5 to 6 months of inventory. If you find a market with less than 3 months of supply, you are looking at a strong seller's market where demand is currently outstripping what is available. Ever wonder why some investors seem to always find the next boomtown before anyone else? It is usually because they are watching the permit office. Check the local city planning commission's website for building permits. If you see a massive spike in new construction permits, that means the supply is about to skyrocket in the next 2 years. Too much supply coming on all at once can crush your ability to raise rents or maintain property values. If you find this approach to market research helpful, hit that subscribe button. I drop deep dives like this every single week, and I want to make sure you do not miss what is coming next. Okay, now for the part I have been saving for you. This is the third method, and honestly, it is the one that most real estate investors completely ignore. It is called the price to rent ratio. This is the gold standard for determining if a market is actually overpriced or if it is a smart place for a long term hold. To calculate it, you simply take the median home price in a specific zip code and divide it by the average annual rent for a comparable property. Why does this matter? Because it tells you whether it makes more financial sense for the average person to buy or to rent. A ratio below 15 means renting is expensive compared to buying, making it a fantastic market for landlords because tenants are more likely to stay and eventually buy or keep renting because they cannot afford to purchase. A ratio above 20 suggests that the market is in a bubble where home prices have decoupled from the actual rental income potential of the area. Think about the massive spike in prices we saw in many urban areas around 04/01/2021. If you ran the price to rent ratio in those cities, then you would have seen numbers hitting 25 or 30. That was a massive red flag. It meant prices were rising solely based on speculation rather than the utility of the houses themselves. When you use the price to rent ratio, you are looking at the cold, hard reality of the market's income potential. You are moving away from emotional investing and toward mathematical certainty. That one shift alone could save you from buying into a market right at the peak of a bubble. Once you see how this ratio predicts market cycles, you honestly cannot unsee it. So, let us look at the full picture. We started by checking the job market to ensure the town is actually growing. Then, we analyze the supply and demand using permit data and inventory levels. Finally, we use the price to rent ratio to make sure the math actually makes sense. These three steps create a filter that rejects the noise and leaves you with only the most viable opportunities. Most people spend weeks scrolling through listings and feeling overwhelmed by the sheer volume of properties. But you do not have to do that. You just need to follow the data. It is not about finding the perfect home on your first try. It is about finding a market that is fundamentally designed to help you succeed. If you enjoyed this breakdown, share it with someone who is currently looking for their first investment property. Subscribe if you want to keep leveling up your knowledge, because next week we are going to break down how to calculate cash on cash return so you can verify that your property will actually pay you every month. You have the tools now. Go out there, do the research, and make your move. I will see you in the next one.